Hello and welcome back to a practical example of Unit Standard 252040, Managing the Finances of a Unit. My name is Monique Ward and I'll be taking you through a practical example of our fast food company, showing you break-even analysis as well as the income statement. Now let's have a look at the product break-even analysis of our fast food company. Our company sells hot dogs and hamburgers. The first thing we have to work out is what are the costs of our products. So the cost to produce a hot dog is in total R4.35. That's made up of our rolls, sausage, tomato sauce, onion and serviette. Together the costs are R4.35. And according to our competition, when we did our market research, it would be fair to sell a hot dog at R10. Therefore, we make a gross profit contribution of R5.65 per hot dog. The gross profit margin percentage is thus 57%. Let's have a look at our hamburgers. Our hamburger cost is going to be a little bit more due to a beef patty costing more. So R7.45 is our total cost to produce a hamburger. Competition and our market research has told us R20 is feasible to sell for a hamburger. Therefore, our gross profit per hamburger is going to be R12.55. A gross profit margin percentage 63%. In order to calculate break-even analysis, you need to understand kind of like how you're going to sell your products. In other words, what type of a product mix are we going to have? And we decided that 2 hot dogs to every 1 hamburger, because ultimately more people can spend maybe R10 than actually R20. So our sales mix contribution to overhead is therefore, if we look at our formula, we are taking 2 of our R5.65s and we are adding 1 of our R12.55. That is what we are saying is going to contribute to covering our overheads in a month. If we look at our fixed expenditure in a month, right now we have to pay off our fast food stand, our hot dog stand. So the bank that loaned us the money is expecting us to pay back R500 a month. And we need to pay the wages of a person to operate the stand for us. And that has been decided at R3,000. So at the end of the day, we need to calculate how many hamburgers and hot dogs do we need to sell in order to break even. In other words, just cover our fixed overheads in the month. Our formula is F18, which is our total fixed overheads, divided by our sales mix that we've already calculated over there, 2385, and this tells us we need to have 146.75 of our sales mix in a month, and if we round that up it means 147. But remembering our mix is 2 to 1, therefore if we have 147 hamburgers being sold, we need to sell double the hot dogs. In other words, in that case, 294. Remember, we made a gross profit of R5.65. So for 294 hot dogs at R5.65, we get our R1,658 figure over here. And the same with our hamburgers, we have a contribution of R12.55 times the 147, we end up with 1,841. So in total, if we sold 147 hamburgers and 294 hot dogs, we would break even in the month. So just to summarize, product break-even analysis is all about your contribution to your fixed overheads once you have paid the cost of the articles that you are producing. Now that we've discussed our break-even analysis, let's have a look what an income statement would look like if we apply the units that we've just calculated over the next year. So first and foremost, your income statement is made up of sales. So your sales income is at the top, and then you show all your cost of sales, which we've already discussed of how we got to those numbers. And then you bring in any expenses, whether they are fixed expenses, you have to pay that money every month, or whether they are variable expenses. And the main aim of an income statement is to calculate your net profit to see if your business is making a profit or a loss. Let's have a look at January, February and March's figures, where we have anticipated breaking even in the month. In other words, we are just going to literally, at the end of the day, make 6 Rand net profit. All right, that's our break-even analysis. However, we do know that maybe in winter our sales could drop. So we've anticipated a 20% drop in sales around April, May, June and July. This has an adverse effect on our profit for the months because you still need to pay the bank the 500 Rand, and you still need to pay your operator for standing there even though he is selling less hot dogs and hamburgers. So remember now, even though your sales have dropped, your fixed expenses have stayed the same. You have to pay the bank back 500 Rand a month for your hot dog stand, and you need to pay your operator his wages. Therefore, you are making now a loss of 695 Rand in that particular month. This trend continues until about September. You're making a loss of 695 Rand. You have to get your sales back up to the break-even point, which fortunately is anticipated during October, November, December, because we're back into summer, back onto the beach. People like to eat hot dogs and hamburgers, so we're looking good again for the remainder of the year. We will make a loss of 4,136 Rand. But do not fear, because we have just worked it out on our break-even analysis. What happens if you start to sell more hot dogs and hamburgers? What happens to your figures then? Let's have a look at a projection where we are selling now 500 hot dogs in a month, but only 250 hamburgers. Our same sales ratio mix of 2:1. Can you see that? 500 hot dogs, 250 hamburgers. This means we are selling and making a profit now in the first month of January, if we take into account those sales numbers, of 1,925 Rand. Our business is doing much better, and it continues to do that for January, February and March. If we take the same anticipated decline in sales over the winter months, as we spoke of before, and our sales drop 20%, we are fortunately still making a profit of 1,540 Rand, because we are selling more hamburgers and hot dogs than what we needed for our break even. But we've done something else. We've actually decided to structure the wages of your stand operator differently. If in winter you're not selling as many hot dogs and hamburgers, then we have reduced the time that he is spending at the hot dog stand. And that way you actually end up becoming profitable. So you've always got to remember, what can you do? Yes, you can sell more of a product, but if you can't due to market conditions, then you need to actually have a look at perhaps your expenditure. Where could you reduce expenditure to still remain profitable in that month or months where we have to wait until it gets to summer again and we know that our sales are going to be on the increase again? To summarize, we make a total profit for the year before tax of 20,790 Rand. We've made our provision for income tax that is due to SARS, our 28% of 5,821 Rand, which means at the end of the day we have a net profit after tax figure of 14,969 Rand. Basically, a cash flow is just literally all your money that's going into your bank and then going out of your bank again. So we are receiving payments for our hot dogs and our hamburgers. We're receiving possibly cash, or we might even have, if we get big enough, have a debtors account eventually. But for now, our cash flow is literally just money coming into the bank, which is our income, and then our money going out of our bank, which is in the form of our cost of sales, having to pay for our buns and our sausages and meat, etc. And then lastly, it's for any fixed and variable expenses that we might have. And we start a cash flow analysis with an opening bank balance, because at the time when you start your company, you should have a little bit of funding in your bank to be able to cover some overheads until you make your sales, or to at least buy your products to sell. So in our case, we started with 1,000 Rand. In the month of January, we had income of 10,000 Rand. So if we go back up again, we can see here it was because of our sales of 10,000 Rand hot dogs and hamburgers. So that's our income in our cash flow. And then our cost of sales figures is the total of all our costs of sales. There we go. For January was 4,038 Rand. And then our expenses, less expenses. In this case as well, we've got our operator wages, and then we've got a bit of cooking gas we've had to pay for, as well as we gave our wage earner a bonus. We would like to encourage our operator of the fast food stand to sell more hot dogs and hamburgers. That way our sales go up. And what happened is this worked, because now we have sold 500 hot dogs in the month of January and 250 hamburgers, which are way above the break-even figures that we needed to sell in our previous example. If you can recall, we needed to sell 294 hot dogs and 147 hamburgers. Now, we've actually sold 500 and 250 respectively. So for that, he earns a bonus. So that's also going to affect our cash flow. Our expenses have gone up, and we need to actually take that into account. And then last but not least, in a cash flow analysis, you also need to bring in any possible payments of liabilities, because your assets and liabilities are actually shown in a balance sheet, which we will get to in the next module. Liabilities are shown in the balance sheet, and therefore any repayments that we make will not actually be reflected in our income statement, but they affect your cash flow. So we bring in here the loan repayments for the fast food stand of 500 Rand a month. We bring that into our cash flow because we have to still pay the bank back. And at the end of the day, you have a closing bank balance. And that carries all the way through to the end of the year. And we can see there that we are cash flush positive at the end of the year by 15,790 Rand. So to summarize, a cash flow analysis is literally all your money coming into your bank and going out of your bank in a month.